Greetings. Today is Friday, February 9th, 2024, and this is our monthly market monologue. Once again, we are going to break up the monthly commentary into two main videos. Today is going to be about the stock market and what we see there, but we're going to save the economic commentary. Instead of making a video, we're going to instead invite you to a webinar on Tuesday, February 20th. Once again, we've been asked to present our economic update to Reagan Madison and their clients. Most of their clients are CPAs. And so if you are a CPA, you can get CPE credit by attending the webinar, but you do not have to be a CPA or a client of Reagan Madison in order to attend the webinar. If you'd like to attend, I will put the link in the description below. Now, before we dive into this monthly market update, I want to remind you that you should be getting your tax statements in the mail, or if you're getting them electronically, most of those tax statements should be available. However, all of the tax statements should be delivered by February 16th, so I believe that's next week. So we would encourage you to wait to file your taxes until at least February 16th, if not late February or even early March. Again, if you were a client at TD Ameritrade, if you had accounts at TD Ameritrade, you will get 2 tax statements for every account that you have. That said, let's dive in and look at a couple of charts to see where we're at and what we see underneath the surface. On the screen, we have 2 ETFs. Both of them are representing the S&P 500. The one on the left is the traditionally calculated cap-weighted S&P 500 SPY ETF. So again, the one on the left is going to be overly influenced by the largest stocks in the index. On the right, we have the equal weight ETF. Again, RSP on the right is still the S&P 500. The difference is every stock in that ETF is given equal weight so that no stock is overly influencing the performance of that ETF. As a result, one of the things that we take a look at is how is RSP performing in relation to SPY. If SPY is very strong and RSP is very weak, that's telling us, that is one of many things that tell us, we don't have a lot of breadth in the market. We're only seeing a few stocks. That's what happened all of 2023. Yes, the S&P 500 was up in 2023, but the majority of, if not all of the S&P 500 return in 2023, it was driven by a handful, like literally 7 stocks generated all of the return for the S&P 500 in 2023. If you want, you can review the January monthly market monologue, and I walk through all of the math to demonstrate why that is true or how that is true. What we really want to see is we want to see RSP really begin to perform and to either match the performance of the S&P 500 or hopefully begin to outperform it. That will be a clear sign that we finally have a lot of breadth, or we have a lot of participation. And the analogy that we use here quite frequently is generals and soldiers, okay? If you can imagine like a Civil War movie, and if you see the generals yelling charge and they start storming the hill, if the generals are charging and they look over their shoulder and none of the soldiers are following them, that advance is not going to succeed. If instead the generals yell charge and all of the soldiers are following the generals, that campaign is far more likely to succeed. And so the analogy here is those large cap, those magnificent 7, those stocks are the generals. If they're yelling charge like they did in 2023, but nobody's following them, that is a bad sign. That doesn't mean the campaign won't succeed. It just means that it's not a very strong campaign. The odds are stacked against them. So what are we seeing right now? Let's take a look. So let's first take a look at SPY on the left-hand side. And what I want to show you is that from this October 30th low, the S&P 500, the cap-weighted S&P 500, rallied approximately 21% as of Thursday, February 8th. Now, what did RSP do? Now looking at RSP, we see from that same date of October 30th, RSP performed and rallied about 18.8%, so pretty equivalent. However, there's a stark difference in what has happened over the last 8 weeks. Now going back to the side-by-side view, look at what's happened over these last 8 weeks. The S&P 500 has really continued to rally, whereas the RSP, or the equal weight, has really begun to have a period of consolidation. What is that telling us? Well, first of all, what it's telling us is that the cap-weighted S&P 500 as it's continued to advance, but RSP has not, that's telling us that the Magnificent Seven, NVIDIA in particular, has continued to move forward or move higher. However, RSP, what we're seeing in those stocks is that they have started to consolidate. Now, the analogy that I use in something like this, when we talk about a consolidation, it's usually Thanksgiving. If you're like our house, we have a very big, our meal for Thanksgiving is too big and we overeat. Well, what happens after you eat? A whole lot of nothing. A lot of slothfulness is what's going on at my house. Why? Because we've overeaten. We've eaten so much that we just need to have some time to digest all of those calories that we just consumed. That's what's happening in the majority of the stocks underneath the surface. We had a massive advance, an 18-20% advance in the broad RSP or the broad market, and that was too far too fast. That's okay if we see a consolidation. What we don't want to see is a massive advance and then a massive retreat. In this case, going back to the generals and the soldiers, the generals have advanced, the soldiers have followed, they've taken the hill, and they're not giving the hill up. They're now claiming that hill, and they're resetting their camp up for the next advance. Let me show you another reason why we are encouraged by what we see underneath the surface. On the screen right now is the iShares Russell 2000 ETF IWM. This is smaller companies or small cap stocks. And what I want to show you is this period of consolidation that we've seen in the small cap space is really started all the way back in 2002. So it's a period of 2 years where small cap stocks have been what we call range bound. They've been stuck in this range. However, take a look at this. This is the end of September, actually the beginning of September of last year. And what I want to highlight is this, what we're seeing down here when we take these two measurements together. The bottom pane on this chart represents the percentage of these small cap stocks that are above their 200-day moving average. Again, the 200-day moving average is generally considered the demarcation between an uptrend and a downtrend. So if we have a large percentage of stocks that are above the 200-day moving average, that's a healthy sign. If we have if we see an increasing percentage of stocks that are below their 200-day moving average, that's not a good sign. So take a look at this. This is when the small caps they're still in the range. They're in the range bound. They're coming out of this, they're just struggling to get out, and they can't get out of this range, but they start to correct. They correct back down to this 200-day moving average. It bounces back off of this. But what I want to highlight is right here. When we're reaching this approximate level, this peak right here, which is effectively where we came into recently. So at this point, this is early September last year, what we were seeing is a continued deterioration in small cap stocks. So more and more smaller company stocks were falling back below their 200-day moving average. Now, fast forward to what we see here recently. So this is 2024. We start the year off pretty well, but we've gone through this period of consolidation. I just showed that to you in the RSP. What's happened with the small cap stocks? These are soldiers even farther back in line. Are they going to follow those generals? And they have consolidated, but take a look at what percentage of these stocks have fallen below the 200-day moving average. Yes, it came back down, but we've been able to stay above this 50% line. And I see this as really good news because we have this massive advance off of the October 30th low, and we've had that period of digestion, that period of consolidation that is generally considered pretty healthy, but it does not appear when we look underneath the surface, it doesn't appear that any of the stocks or a significant number of the stocks are retreating. We're able to hold that line, and we're actually beginning to tick back up. Small caps had a pretty good day yesterday as an example. So overall, I think that is encouraging news. It's an encouraging sign underneath the surface. Now, the other thing that we want to take that view and we want to overlay it with other data that we have. This is the seasonality chart. This is the average return for the S&P 500 since 1950, but broken down by month. So take a look at February. historically speaking, February is a pretty tough month. Now, this blue dot represents where we're at February 2024. So the S&P 500 has still performed relatively well in 2024. However, remember, that's mainly because those Magnificent Seven stocks haven't really consolidated this month. The majority of the stocks, as measured by RSP and even those small cap stocks, they are struggling in the month of February. That's in line with what we expect from a seasonality. From a historical perspective, that's very, very natural. But what historically is around the corner? We have March and April, two pretty good months. So overall, we like what we see underneath the surface. Yes, we've had a period of pause in some of these stocks, but it is a natural period of digestion. Again, the soldiers appear that they have followed the generals, and they've claimed the hill. They're not retreating. It appears to us that they are preparing for their next advance. That'll do it for today. Hope you find these videos helpful. If you haven't already, we certainly hope you'll hit that subscribe button. By all means, feel free to share the videos with others you think might find value in either the videos or the work that we do. If you're not familiar with Hicks Associates Wealth Management, we serve individuals and families by managing their money and giving advice from a financial planning holistic perspective. If you want to learn more, just visit us at hicks-associates.com. Until next time, thanks for watching, and we'll talk to you soon.